Guys, Amazon, Intel just reported we have Apple coming up next, so make sure you subscribe to watch all of our earnings reviews. People love them. I get messages on Instagram, people saying, Paul, you're the smartest, most attractive man of all time. I want my wife to be with you, but I can't because she and I love each other and you love your fiance. I don't know why I just said that. Okay. Amazon. Amazon to start the day was at $116, basically. It is now at $92. Now, I've had stocks go down, but I've been preaching about how overpriced Amazon is for a long time. The one-year high of 188, it's currently at 92. That is over a 50% drop on the biggest company. I remember being told a year and a half ago, Paul, did you not learn your lesson on Amazon? I shorted Amazon years and years ago, and I was fully wrong. Did you not learn your lesson, Paul? You're so stupid, Paul. What the hell is your problem, Paul? I don't know. But guess what? Amazon is still fallible. They reported 28 cents per share versus 20 cents. That's good, right? The revenue came in at 127.1 billion versus 127.6 billion expected. Mo, did it say anything else about, oh my God, Intel's actually up?
Intel's positive.
So guys.
So we were right. Obviously.
So everybody here knows, if you watch our channel, I own Intel. Intel's taking a beating. And you might sit there and say, well, Paul, how can you criticize Amazon for being down half and Intel, since I bought it, down 40%? Well, there's a difference. One has a reasonable justification of valuation. The other one does not. So Intel also reported. Mo, what did they report?
Intel came in 59 cents per share, beating expectations of 34 cents, and $15.3 billion in revenue versus $15.43 billion. So missed on revenue.
So both companies missed on revenue.
Yeah, so they've guided forward. Intel guided forward. $1.95 to $2.15 per share going to
for the year.
For the year, and 63 to 64 billion in revenue. So
okay, so still down quite a bit.
Yeah, down quite a bit, but the
valuation
hasn't changed.
It hasn't changed. Intel is spending a lot of money on that $20 billion factory here in Ohio, just down the street from, I say down the street from us, an hour and a half.
So somebody that you and I both know, he's been going to that factory 2 times a week. He's been driving down to Columbus twice a week to go and check it out. He's like, it's getting underway. It's going to be pretty awesome.
Awesome.
Yeah.
I'm glad. Text me on who that is. I don't know who you're talking about. Okay. All right. So remember, on this channel, investing can be hard. The numbers can get very overwhelming, and I understand it. I understand that completely. I used to be in the exact same boat. And even today, I'm still learning every single day about companies. I learn about valuation. I learn how to look at things. So if it sounds daunting, you're in the same boat as everybody else out there. Warren Buffett at one point was a 12-year-old kid buying stocks because somebody told him this company is great. He bragged about buying stocks because Ben Graham liked them. And the person at the time said, don't ever buy a company because somebody else likes it. It was a very early lesson he had to learn. So if this sounds confusing, rewatch the videos. Rewatch them. Watch our other videos. We have 1,800 videos on this channel. We do 2 or 3 videos per day, so make sure you subscribe. But let's look at Amazon and see what is going on here. So they're down 18.5%. Let's see what analyst estimates are.
18.5%.
I mean, whoa.
This is not like we're talking about some company, some fly-by-night.
Is this right?
Disruptive company.
Amazon analyst estimates expect $24 per share in profit in 4 years. Is that correct? What the heck? That's a big jump. So
$912 billion in revenue by end of 2026.
And it's okay. So $24 a share in profit. So, 24 times the 15 multiple is 360, and it's currently at 90. I mean, if that's, guys, if this is accurate,
it's all day.
If God came down to me right now and said, Paul, they're going to make $24 a share, I'm putting my life savings in Amazon right now, right?
Yeah.
Because 15 multiple, you're at 360. The stock's currently at 90. You're going to 4x your money in 5 years. That's a really great return. So the question is that realistic? I mean, there's 28 analysts on this, Mo. Isn't that weird?
Yeah, 29 analysts on the revenue side. All
right. So let's go to the 8 pillars tab. Oof.
I would assume.
Oof.
Yes. Okay. I had a feeling return on invested capital would be low. Debt might be a little bit high.
Well, the return on invested capital is low. Look at this cash flow growth. They've had $38 billion decrease in cash flow in the last 5 years. But I want everybody to look at this. I know Amazon spent a lot of money on CapEx. Look at this CapEx expenditures. 10, 13, 14, 24, 52, 65 billion in the last 12 months. I mean, they're really spending a lot of money on capital expenditures. This is what Amazon does. And by the way, guys, I love that. I love, it's funny. We were upstairs about 2 hours ago. For those of you who don't know this, I have 8 or 9 businesses upstairs. Don't ask if it's 8. Don't ask if it's 9. It's a long-term joke. In like our 3rd video on YouTube, I brought it up. So I heard my brother, I was walking by an office, and I heard my brother say, profit doesn't matter. And he was saying that because I was walking by. And I said to him, I go, listen, profit doesn't matter as long as we are reinvesting all the cash flow into more high return opportunities. And if that's happening here and they're able to get a really high return on the money being invested, then absolutely that's a great thing. And this is the hard part about long-term growth of companies that reinvest back in themselves. The numbers might not look good to start or for a while.
So I look at their return on invested capital and say, well, they're reinvesting in themselves, but it's not working very well.
Well, not necessarily, because our return on invested capital is based on free cash flow. So when you reinvest back in yourself, what are you doing to free cash flow?
Depleting it.
Yeah, but it still could very well be working well. Look, because look at operating income here. 13, 18, 22, 36, 51, 59. It's a big drop this year.
So question, since we know that they don't make money pretty much anywhere except for Amazon Web Services, how does that make you feel?
I think that's going to be changing soon. I think the retail side with their advertising, we have a few businesses that sell on Amazon. We spend a lot of money on advertising. Yeah. I still feel like the maturity of this business and what's Amazon becoming, for me, I don't know if I understand it well enough to understand the valuation.
And the top dog, since Jeff Bezos has stepped down, this new CEO, he's definitely been.
Oh, that's right. I forgot about that.
Cutting. And I mean, he's not going and wildly spending. They got rid of something in their healthcare arena. I can't remember what, Medical One or something like that. So,
ironically,
maybe
though,
they're not going to be spending as much as they were in the past.
Isn't it crazy? The last time they were at $90 a share was before COVID.
Wow.
That's during COVID. Sorry, during COVID. During COVID, March 9th, they were at $90 a share. March 9th, I think March 23rd was like the low, or Dad's birthday. March 16th, $84 a share. So they're almost at their COVID low. Yep. They're a few bucks away. All right, 19% down right now. So what are we willing to pay for Amazon? Let's do assumptions. This is going to be the hardest thing in the world.
Yeah, this is going to be a tough one.
All right, revenue growth assumptions. What are the analysts saying? Because we're going to do a 10-year analysis, guys. I don't want to do a shorter one. I want to focus on 10 years here.
Absolute mid-teens. 15% is basically what they're looking at.
Okay,
Maybe
so we're going to go at 10
14%.
years, so we have to go lower number. So I'm going to go with 4, 8, and 12, or is that too low, Mo? Is 12 too low?
I was going to say 4, 7, and 10.
I think 12 is fine if they really crush it.
Okay.
Man, that's going to be, wow, that's going to be like $1 trillion something.
That's the problem. I mean, if even let's say that they do what the analysts say in 5 years, it's at $912 billion. That's a lot. I mean, it's not.
All right, let's do 4, 7, and 10. All right, profit margin. I mean, I think their profit margin, remember guys, when I talk about reinvestment, that's not taken away from profit margin. That's taken away from free cash flow margin, which you can see is definitely lower than profit margin. Okay. So that is a big difference here that I'm hoping everybody sees. And this is something you can learn on this channel as you watch more and more videos. If you watch 4 or 5 more videos, I guarantee you'll have a better understanding of money and investing, because the more you learn, the more you understand, the less you fear.
Absolutely. This is all repetition, guys.
All repetition. So why don't we go 4, 6, and 8%? Because if AWS really grows and they're able to make profitability on a lot of things, but their gross margin isn't very good. Can you find out their gross margin? I think last time I checked it was like 25%, but it might be higher now.
13.
Oh, there's something wrong there. Oh, they must have had some fluke leasing. Okay. Free cash flow margin. I'm going to go with 3, 5, and 7. Now, PE. Guys, Amazon's PE is currently 97. Mm-hmm. The reason you pay a high PE is high return on invested capital / moat, which Amazon has the moat, but not the return on invested capital. Correct. And potential really high growth rates at the end of your analysis period. So after it's already $1 trillion plus company, how much faster can it really grow? So, Mo, give me your PEs.
13, 15, 17.
Yeah, I like that.
which sounds ridiculous at this moment in time, but.
Yep. Now for desired annual return. Guys, you can get 9 or 10% in the long run over a ETF. So to get margin of safety, you have to require a higher return. And the higher assumptions you make, the more return you need. So Mo, what's the desired annual return for this company?
12, 14, 16?
God damn, that's exactly what I was thinking. It's down 22% right now.
Unbelievable. What's our numbers?
Ready?
I am.
18 to 25, 60 to 70, 35 to 45. It's on my watch list at $75. That doesn't mean I'm going to buy it at 75. It means I'm going to start selling puts when it hits 75 because the momentum will be big, the volatility will be big, and I'll be able to get a lot of premium to buy it at lower prices.
So to me, the question on Amazon becomes, do you want to own Amazon in general?
Yes, I want to own Amazon.
Okay. Then
you don't?
Huh?
You don't?
No, I'm not saying that. I'm just saying, do you? Is this something like legitimately on your watch list where when it gets to 75, you're going to be like, okay,
I don't like the margin. I don't like the margin.
Yeah.
It's not great, but this is the everything company. You know what I mean? And
They do sell
AWS is still the leader in cloud computing, and I think their margins will get better. So let's go back up here and change a few assumptions here.
The only reason I asked you is because I think you said in the past, I asked you one time and you were like, maybe.
Did I really?
Yeah.
Was that private or on video?
I think it was on video.
So if I change the assumptions on profit margins to 6, 8, and 10%,
Yes.
and increase the free cash flow of 5, 7, and 9, I mean, we're still a ways away.
Yeah.
Even on the high side, we still got to go down about another 10, 11%. So I think we're getting closer. And guess what? It's way higher than the value was when I started shorting it. So that's good. And I'm no longer my short. I licked my wounds. Let's go to Intel now, Mo. You handle that one.
Whoa. It's up 7%. When's the last time Intel was ever up 7%? That's incredible. So
do I have covered calls in my Intel position?
I told you not to.
Oh, I didn't. I didn't.
Good boy.
Because my guy at Merrill said, Paul, are you sure you want to put covered calls on there?
Boy.
Yeah, good boy is right. Because my guy at Merrill said to me, Paul, are you sure you want covered calls here? Earnings are Thursday. I was like, good catch. Don't do that.
Yeah. Wow. Okay. Up 7%. Guys, they beat on earnings per share. Look.
This could also be a thing that people are exhausted of selling Intel. It could be it's
true.
oversold. It's
This
like,
could
okay.
be oversold. I mean, even on Meta, I was looking at this today. I'm like, man, where's the point where it's kind of oversold? Because, everything here with Intel, as far as the one concern I do have, they're spending a lot of money
On CapEx?
on CapEx.
Yeah.
The one thing, but they're going to be getting a lot of money from the government from this CHIP Act bill and what's going on. I texted you the name of the person. The plant in 20
If it's who I think it is, I don't trust.
Okay, let me know. I think you.
Oh, no, he's awesome.
That's exactly right.
I trust him 100%.
Okay. $20 billion down in.
Is he involved in the
Columbus.
project?
Yeah, in some way, in some capacity.
He's an awesome human being.
He's awesome. Yeah, great hair.
He does have great hair. You're right.
Let's see what the analysts here say.
What? Connor.
Earnings per share.
You should have said Connor because he'd be too happy that we mentioned his name on air.
Yeah, he would faint. $2.21 now and going to $3.71. So remember, here's the thing about Intel and that a lot of people jump down our throats for. You don't need to go out there and pick the best company in the industry. It doesn't need to be the leader. You just need to pick you can pick the number 3 company in the industry and it can be a really great company. And I read some article the other day that Intel was catching up to AMD now. The tug of war is going back at the Intel side. So who knows if that's true. Now, the revenue growth, not a lot of it, Paul. 67 billion to
75, which is still lower than their peak before. But look at their earnings per share, 371 potential. Apply a 15 earnings to that. You're at 45 and 70%. You're at low 50s, which we were buying in the mid 40s and below. So we're still down a considerable amount.
For sure.
My basis in the low 40s. I thought Intel would be worth more money. I didn't expect this big, but that's why you have margin of safety. Because when it was in the low 50s and I was doing my assumptions based on revenue growth, I did not expect Intel to go from 78 billion in revenue down to 63 billion in revenue.
Does this concern you at all?
No, because look at their cash flow numbers. I had that pulled up. Come here and look at this. 10, 14, 14, 16, 16, 24.
There you go.
This concerns me more. Cash from operations being lower. But
could that be a fluke?
Well, it could be a fluke because of the big drop in revenue.
Exactly.
But the whole goal here is if these capital improvements work and they become, I mean, I think it's going to be the biggest chip manufacturing in the country. The country. So, yeah.
All right, let's put a price on this one. So, as Paul said, we've been in Intel for a long time. Paul, give me some numbers for revenue growth. Let's be conservative here and really beat it up as we've done. And
0.
Yeah. Okay.
2.
Yep.
4.
Okay. Profit margin?
Let's go 20.
Okay.
22. 24.
Okay. Same for free
18, 20, 22.
I think that's a good idea.
Even though I think the profit margin and free cash flow, especially in this company, will be equal in the long run. Now, PE, I'm going to go with, what's his name? Some people think it should be, I would say 10, 13, 16. Same thing there.
And desired annual return.
12.
I like it.
13 and a half, 15.
All right, guys, whatever this spits out doesn't mean go buy it. Go do your own research on this. This is not just because a stock falls a lot doesn't mean go buy it. Currently sitting at, well, we're going to open the day tomorrow as of right now at $28. 31 to 28.50, $51.
And this is, and I want to repeat,
$40.
And I want to repeat, this is why we have margin of safety. Because when it was the low 50s and it shot for like 60, $65, I didn't buy some. I just kept selling puts below 50 at like 45, collecting income. And when it started to fall, I started getting shares and I have more puts on it at lower prices. So
here's the thing I like. You put in there 0% revenue growth for out 10 years and we're still.
And a 10 multiple of earnings.
And a 10 multiple of earnings. Yeah. And we're still green.
Yeah.
That's a good thing.
So again, 3 questions to ask. And this has become my thing. Do I think Intel will be around 10 years from now than today versus today?
Yes.
Not versus today, 10 years from now. 2, do I think that Intel's revenue will be higher 10 years from now than today?
Yes.
Revenue and profit. 3, if the answer to both is yes, can I buy it for a reasonable price today, factoring that all in and factoring the balance sheet that gives me a really good return on my money?
I think the answer is yes.
So for me, I'm comfortable with Intel at this point. Does that mean I'm going to be right? It's a home run. Do not buy just because I said it. I have 8 or 9 businesses upstairs. I have hundreds of apartment units. I have options income that supports my entire lifestyle. I can be as patient can be. Only 7% of my money is currently invested in stocks because I'm waiting for better opportunities. But on Intel, I'm hoping that we're getting close to a bottom. Probably isn't a bottom, by the way. It's probably going to go lower because I do think the NASDAQ is very overpriced. Mm-hmm. But you need to subscribe to this channel because we have so many videos. We do 2 or 3 a day. We have our exclusive community on everythingmoney.com where people get access to us. It's wonderful. Thank you very much for your time. Apple's coming up next.